So I want to review the concept that we came up with, which was a singular way of seeing all P&Ls. As I said before, if you have a room of 100 business owners and they all put their P&L on the table, you'd have 100 different views if they were using some other accountant. In our belief, if those 100 people were our clients, they would actually have exactly the same looking P&L in terms of structure and analytics to allow them to actually have a common conversation about their business model, even though they might be in a totally different industry. So the way that I want to show this is I go back to an example that I had in the original book of the construction company compared to a services business. So the construction company, you can see, has $20 million of revenue. Maybe good, maybe bad, but we start there. Services company has $3.7 million of revenue. You can see cost of goods sold, the next line item. These are really all of the expenses that are paid externally in the business. And so from a construction company standpoint, it's going to be materials and subcontractors. From the services business, it's probably either subcontractors, freelancers. But the idea is, the way to think about it is, it's money that goes outside of the business. So really the next line down is where we believe that true economics start inside the business. And that's a term we use called gross margin. Now you'll hear a term called gross profit. Gross profit really is something that there's not a common definition on. Even gross margin, you're not going to have a common definition. So the simple numbers definition of gross margin is revenue minus all of those costs other than labor that I pay to somebody outside the business that's directly associated to the revenue that I create inside the business. So from that standpoint, you can say that really that's where the internal economics start, is that gross margin line. And you can see here that I've illustrated it as both companies have exactly the same gross margin. So think about it. I mean, you got one company walking around saying, hey, I'm a $20 million business. And you got another company walking around saying, hey, I'm 3.7 million. And the person that makes 3.7 million, even in their own mind, they don't think they're the same as the $20 million business. And yet they are in that regard. So that's really kind of where you start the process. So the next line item is direct labor. So when we talk about direct labor, think of it as the people that you have in your business that faces the customer, that does the things that you do or sell or produce. And so it could be warehouse people, it could be field representatives, it could be customer service reps. And think of it like this from a standpoint of, we call it a butt in a bucket. I don't fractionalize people and put some of their cost up into direct labor and some of it in management labor below. I want to take a person and say, you are critical to this function and you've got to go here. And then by default, everybody else goes in the management labor that we'll talk about here in just a bit. So from that standpoint, and the idea is don't stress out over it. From a standpoint of what you're trying to do is create an internal benchmark that it doesn't matter maybe that somebody else calls that person or that role differently. What matters is this gives you an ability to watch the productivity of that labor grouping across time. So once we put direct labor in, you'll see the next subtotal we draw is contribution margin. So contribution margin is probably the equivalent of what you see, say, in a QuickBooks P&L, or most traditional P&Ls is gross profit. So the traditional accounting methodology would put both labor and other direct costs that are directly associated, because the mindset is direct cost. I get that, but when I was putting my original data set together and research for my book project, I realized that labor needed to be broken out separately. Labor has its own unique relationship to the economic output of the business. And what we realized is labor is the cost that comes to work every day with an attitude. Materials are materials. And so from that standpoint, the key relationship here is the term you see below, direct LER, which is gross margin divided by direct labor. And LER stands for labor efficiency ratio. And so what we believe there is you're taking for every dollar of labor that's input, what is the output? Traditionally, you'll see people control labor costs by looking at it as a percentage. I believe that that's a reductive mindset. And I think really a productive mindset is for every dollar of good labor deployed, I should get a multiplier off of it. And you'll find that your direct labor employees, when their productivity is measured this way, reported to them this way, they're going to be much more productive because they like being a producer, not a reduction of something. So once we get down to contribution, you can see that revenue, direct cost, direct labor represents what we call the business engine. I personally believe that contribution margin, that the output of that business engine, is the critical number in every business. I don't really care what percentage it is relative to revenue. It may be an indicator or something, but yet the raw dollars of contribution margin, I believe, is the critical number that we base a lot of performance plans off of, business. And we believe that the actual production of that number is what's critical to track and to measure. So once we do the business engine, the next thing we move into what we call the business chassis. And so think of it, I've got this engine that I've got to manage. I got to move it around. So what's the chassis of that business? Well, that's really what most people traditionally call SG&A or overhead expenses. We prefer to call it operating expenses. These are the cost of operations that are very difficult to turn on and turn off on a whim. So essentially, in our research, we came down to 5 key buckets that we put this cost in. And the reason why we use the 5 buckets is in college, I was taught in accounting that there were really 2 types of cost, fixed and variable. What reality has taught me is there's really no such thing as a fixed cost, because it's fixed to a point of capacity and then it drifts up or drifts down. Then I have a variable cost that's variable to a point. Oh, wait a minute. It then stops to be variable. It then changes its characteristic. And so what I have chosen to do that is proven to be more effective in terms of forecasting and predicting data is we use characteristics of data. And so the first one we use is facilities. So facilities is all your infrastructure costs of rent, utilities, repairs and maintenance, telecommunications, IT costs. Anything that is part of the infrastructure of the business that you're going to use no matter what. The second cost we look at is marketing. Marketing is essentially probably more likely more of a variable cost, but it doesn't have to always vary. In many cases, we see people not spend enough on marketing, and really they should increase the spend. But this is all external marketing spend, so this does not include any marketing labor that's internal in the business. We have a separate measurement of marketing that we'll discuss in a different presentation in terms of how to measure marketing performance that we believe works pretty effectively. But in this particular case, just for capture of the data, I want to capture all external marketing spend. Then I get down to management labor. So by default, anybody who's not direct labor, they're in management labor. And so once again, it's a butt and a bucket. It's all those people. It's not taking a person and fractionalizing between one or the other. If you have some doubt, think about the direction of the organization if you're an emerging business. If somebody is ultimately geared to be a manager, I would more err on the side of putting them into management and then growing them out of their direct responsibilities, if that's the case of somebody who's in transition. But there again, don't sweat over it, because it's one of those things that, put them in one bucket or the other and just be consistent in terms of that role, whether that person changes jobs or not. The next piece is payroll taxes and benefits. It's probably the most purely variable cost that you'll have, but we don't believe in taking it and spreading it out throughout the other labor costs. Now, that is a technically correct presentation in accounting, but I believe that when you take a cost and allocate it out, you lose control of that cost. And by putting it in a pool and watching it, I can better manage whether or not my payroll taxes and benefits relative to all labor is drifting up or down in terms of percentage to labor. The dollars are going to drift, certainly, but it's one of those that when people see on a P&L where the dollars have gone up, well, as long as that percentage stays relatively the same, really those costs have stayed the same. The last piece is other operating expenses. So if something is not facilities, if it's not marketing, if it's not management labor, if it's not payroll taxes, it's not a direct cost, by default it's other OPEX. And so that other operating expense, think of it as just the cost of doing business. It is all of the other things that are going to occur, you lump in there. Now, the thing is, it's going to do this on a monthly basis because it's a lot of random items. What's interesting, though, is once you look at it on a rolling 12 basis, that you look at 12 months of trailing 12 data on it month after month after month, it's more like this with a slight trend towards whether or not you're growing or declining. So it is what we refer to as a lagging variable cost, in the sense that if I have a sharp increase in activity, my operating expenses will lag in its growth. but they will eventually drift upwards as those costs, many of them set on an annual basis in that process. So what that gives us then is net operating income. So contribution margin minus operating expenses is net operating income. And to us, that's really the production output of the active business itself. Now, some people will refer to this as EBITDA. It's almost exactly like EBITDA, except the fact that sometimes I will say that we will actually take depreciation and move it up into the operating expenses, typically in facilities, if we really believe that depreciation is more a true reflection of cost as a facilities cost and not below the line. But there's a lot of businesses these days that really don't have much in the way of depreciation anyway because they're not facilities dependent, or at least from a capital asset standpoint. So from that standpoint, think of anything below net operating income as non-operational. So it could be some type of other expense that's randomly occurring, lawsuit. Sometimes we'll actually look at putting research and development expenses below the line because it's something that I'm taking profits of the business to look at reinvesting for future benefit. And so in one of those cases, you have some flexibility to use that section to decide what are the things that we're actually choosing to use out of profitability. Then you get down to pre-tax net income. Now, I typically choose for analysis purposes to stop here. Now, if you're in a C corporation in the U.S. that pays taxes internally, if you're an international business where you pay taxes in your local country through the business itself, you would have an income tax and then a net income number. In the U.S., the vast majority of businesses do not pay taxes inside the business. So typically you'll just stop at pre-tax net income because the owner will have to take tax distributions off the balance sheet to actually pay their taxes, personally. Here's the final key, that you look at from a standpoint of profitability. So from the standpoint of profit relative to revenue is 2.63% from the construction company. Well, that's not exciting. But the thing is, if you really look at net profit as a percentage of gross margin, 18% is pretty good. And what you really realize is, hey, you're pretty profitable as a construction business because here's the thing. That $17 million of cost of goods sold, you didn't have to pay any money out of pocket to get it. Because typically you're going to take a draw against the job to pay for the materials. You're going to not pay your subcontractors until you get paid. And so you don't have any cash requirements in that cost of goods sold. And so the reality is you're not a $20 million business as a contractor. You're a $2,850,000 construction coordinator. Now, that may hurt your feelings. I'm sorry if it does. But at the end of the day, that's the reality of your economic model. For the services business, they're a $3.7 million business. They made 14% profit, but they made the same 18% on gross margin. Now, my rule of thumb is this. If gross margin is 40% or lower, I want you to use gross margin as the true top line for your metrics of profitability and any of those things. If your gross margin is 40% or higher, I want you to use revenue. Now in the services business, I teach it this way. It says, well, you were 14% as a percent of revenue, but if you can find a way to, instead of outsourcing the $900,000 that you spent in cost of goods sold and do those services yourself, you actually could have made 18%. And so that's really kind of a way to teach people about opportunity costs when, for lack of capacity, they translate costs to another provider, but they lose some profitability because they pass that opportunity through to somebody else. So one final thing is let's talk about labor efficiency concepts. So as I mentioned before, direct labor efficiency, $2.85. So what that means is for every dollar of direct labor, I got $2.85 of gross margin. The $2,850,000 divided by a million. Now, the idea is you don't know whether or not that's good or bad. But as you watch it across time, if labor efficiency ratio goes from 285 to a 3, that means for every dollar that I spend in labor, my productivity went up. If it drops to 250, that means for every dollar of labor I spent, I got less gross margin out of it. So really, labor efficiency is more about the key of telling me, am I getting more efficient or less efficient? Am I running hot or am I running unfocused? And so that's the value of that. Now, there are some indicators that we'll talk about in some later presentations, but at the end of the day, that's really a good starting point. Management labor efficiency, though, is calculated differently. Whereas direct labor can only do the gross margin that's put in front of them, Management labor is held to a higher standard. There's three elements that come into direct labor efficiency. Management labor must drive revenue, control direct cost, and control direct labor. So I must get the optimization of the three to get a dollar to drop out as contribution margin. So we use contribution margin as the numerator to hold management labor accountable. So in this model, for every dollar of management labor that was spent, we got $2.47 of contribution margin. Now, here's what I will tell you. Whereas direct labor efficiency varies across many business models, there's probably a higher than average indicator that says for management labor efficiency, you need to be about a 3.5 if you're 5 million and under. And really, if you're under $1 million, the numbers can get a little, out of range. But between that $1 million and $5 million business, we've seen a pretty tight correlation that many businesses need to be in that 3.5 to 4 range. Once you get over 5 million, the numbers start to normalize around a 5 to hit our profitability standards. And so it is one of those things that really you can hold your management team accountable to where I can now give them something to aim at. And then I can also say that based on adding the next dollar of management labor, whether it is in a raise, another person, or paying somebody a bonus, let's make sure that where's that output of contribution margin going to come from to pay for that dollar, that I gave out in a raise, because that must stay ratable throughout the range of the business. And we'll share some of that when we look at some of our study data, in other presentations. So from that standpoint, that gives you really kind of the idea of why we really believe that this presentation is more powerful than any other version of a P&L that the profession has come up with, that really is just giving the absolute minimum required data for a bank or a financial analyst. And that's one of the reasons why many of you have given financial statements to a bank, for financing, and then you end up getting multiple questions back from the bank asking deeper questions because really the initial presentation was insufficient. What we find is when we provide this data to the bank, they don't ask any further questions. They know exactly what they need to know. So from that standpoint, we believe that this is powerful data that will help you run a profitable business, improve labor productivity, allow you to pay market-based wage for market-based performance, and really allow you to scale your business, which is what's most important. In a challenging business time to where we don't have enough labor to get everything done, but we've got to be competitive and we've got to stay ahead of the competition. So hopefully that will help you understand your P&L much better.